So the first theme is the financial inclusiveness theme. In the financial inclusiveness theme, what we are trying to play is the huge opportunity in the retail credit penetration in India. The retail credit penetration in India is still far below compared to some of the developing economies as well as the Asian countries. We have played this in the past in large caps using private sector banks. We have seen private sector banks like HDFC Bank growing for multiple years by creating a good retail franchisee, both on the liability side as well as on the credit card and personal loan side. By playing this theme, these companies have created a meaningful ROA much superior than the PSU banks in the long term, and this has helped in a huge market cap growth for the private sector banks. So this is one theme that we play. The second theme that we try to play is in the mid and small cap space in the financial inclusiveness side. What we try to avoid is we don't want to invest into any business here which is competing with the private sector banks or a PSU bank from a cost perspective as well as on the asset side. So it is predominantly NBFCs or the small banks who have an NBFC sort of an asset book. So the yield is higher and it is the ROIs are much higher, and the key here is that they are trying to shift people from the unorganized lending to organized lending by giving a flexible tenor as well as lower interest cost. So the EMI still remains the same, but just that the borrower tends to pay it over a longer period of time. This opportunity, in our opinion, is well played by some of these NBFCs and small finance banks, and they have created a good business model around it. Good thing is these companies have potential given the huge opportunity that they can grow by more than 25% for a 5 to 10 year time period. And also they have shown in the past that they are able to underwrite these loans at a very low credit cost in the previous cycles. So the key is that you have fast growing financial services companies, but also you have companies who have managed to underwrite it and keep the credit cost lower, and that leads to a good profitability growth from a long-term perspective in these businesses. So the financial inclusiveness is about playing one bucket of private sector banks as well as some of this mid and small cap bank or NBFCs who are playing into this unorganized to organized retail shifting. So to give a further explanation to the second bucket that we said in the financial inclusiveness about playing the unorganized lending to organized lending, let me give you an example with AU Small Finance Bank. The key is AU Small Finance Bank as an NBFC sort of an asset book, but on the liability side, after becoming a bank, it has spent a lot of money to increase its CASA deposit. So just imagine this and compare with other NBFCs in the same space. It is predominantly into vehicle financing and small business loans. So here the NBFCs, say Cholamandalam or even a Sriram City Union or a Sriram Transport Finance, compared to these companies now, AU Small Finance Bank will be able to lend at a much lower rate given the CASA deposit that it is rising, and compete with them for a longer period to come. We like such opportunities that you have a banking license but you are competing with NBFCs. That really puts you into a very good sweet spot, and you are into sectors where the growth opportunities are for a long period to come. So those are the kind of opportunities that we are looking for. So in the Phygital Bluechips, the intention here is to invest into companies which are either tech platforms or technology companies which are helping the large say blue chip companies in their technology or digital journey. So let me here we find a lot of opportunity arising now in the technology platform space itself. This can be either played through Indian companies, Indian technology platform companies, or IT outsourcing companies who are into special digital capabilities, who have special digital capabilities. The first spot that we are trying to play is, if you look at India, the online penetration is still fairly very low in various consumer facing segments. Like for example, if you look at the food delivery businesses in India, the active users are still only around 2 to 3 crore users in India. If you compare this with China, the number of active users are as high as 50 crore users on an annual basis. So there is a long way to go, and penetrate in some of these technology platforms is what we feel. Another example is online beauty market. If you look at online beauty market, 40% online penetration in China. In India is just around 6%. So there's a long way to grow in the online penetration in some of these consumer facing segments. India has shown to the world that when it comes to adopting the technology, UPI, the way the Indian population has adopted the UPI for the payments, it shows that we can show a lot of online penetration in other segments as well. And a lot of other key enablers are there for many of these services getting shifted to online platforms. So some of these companies have capability to grow by more than 30% for the next 5-year to 10-year time period, given the low penetration level that we are in. Here we feel that investors get confused between what is happening in US and India. Some of these technology companies are getting beaten down in US, but you have to understand that we are in a different phase of penetration story compared to what these platforms are seeing in US. There the penetration levels have already reached 30% across various platforms. In India, we are still in single digit in some of these facilities or services. One of the example that I can give here is food delivery platform Zomato. We invested in this stock after a stock has seen a massive correction in the last 6 months. We started seeing opportunity or value in it after the stock came to the kind of fair value level that we are very comfortable with. Now we have started building our position in the stock. The good thing about a platform like this is at the unit level, for every order that Zomato delivers to you, Zomato already started making positive contribution. That's a very important point that we look into whenever we get into any of the technology businesses. The second point is, as I said, compared to just 3 crore active users in India in the food online delivery platforms, compared to 50 crore online delivery transacting users in China, there's a long way to go. We don't want these companies to get into a profitability sort of a rhythm quickly. We want them to bring more transacting users on their platform. Just remember this, that for every order that a restaurant gets on an online platform, they make 70% gross margin. And the fixed cost is same, right? There is no additional cost that you are going to spend just because you are going to deliver an additional order on an online platform. So they make almost for a 400 rupee order, 250 rupees sort of contribution. So sharing more with the online platform is not really going to impact them. Actually, it will drive their margins. And this is what exactly happened with the Domino's for the last, say, 5 years, by which the Domino's margins moved up significantly. So sharing that to the online platform companies is not a great deal in my opinion, and that is the economic value that the online platforms like Zomato will offer to the investors from the next 5 to 10 year time period. So this is the reason why we like the technology platforms, but it is important that you get into these companies at the right valuations and not really get carried away with the momentum. So that is what we wanted to say. Under the consumption Czars theme, the intention here is to play the consumer discretionary space. Let me first tell you why we like consumer discretionary compared to consumer staples, and this has been our sectoral call for a long period, and we have made meaningful returns to the investors by selecting certain stocks in the consumer discretionary space. The reason is that as every economy goes through a different phase of growth and they cross $2,500 per capita income, the growth levels in different consumption baskets change. So consumer staples are generally seen already well penetrated at these levels as the economy touches a $2,500 per capita income, and consumer discretionary starts growing. And this is exactly what happened in China for the last 10-15 years. And various other economies which have gone through this phase this is what has happened. An average family, nuclear family in India, or an average Indian will start spending more towards consumer discretionary items like consumer durables, traveling, QSRs, education, hospitality. So it is predominantly the urban consumption story that we are trying to highlight here. The further refining that we have done is we play small ticket consumer discretionary and not large ticket consumer discretionary. So what is the difference here? We are trying to play dinote businesses like QSRs. We are trying to play retail apparels of ticket size of spending less than 5,000 rupees, or even consumer durables where the ticket size of spending is less than 30,000 rupees. We are not really pushing ourselves to identify opportunities in the auto sector, which is a passenger vehicle sector, which is slightly on the higher side of consumer discretionary. We try to play them through cycles rather than playing from a long-term opportunity. So the more focus is on the small ticket consumer discretionary space. And here what we have seen is, let me give an example where we have made a lot of money. Titan. See, Titan is an organized retail in the jewelry space, and jewelry space in India is not a fast growing space as such. So it's probably growing in mid-single digit, and Titan has something like a 5 to 6% market share in this. But what we observed in Titan is that Titan can actually start gaining market share from the unorganized players as well as from the weaker competition. If you look at Titan's profitability, it is substantially higher than the next best jeweler in India. And this provides Titan an opportunity to keep on adding new stores in first in the metros, then in tier 1 cities, and then into tier 2 cities. Today, as we speak, when we invested into this company, the company had just 100 stores. This was 8 to 9 years back. Today, we see Titan is almost having 400 stores only in Tanishq jewelry. I'm spending a time on jewelry alone because jewelry is where they make a lot of profitability. 90% of profitability comes from here. So from an 100 store jewelry operator, they've now moved to almost 400 stores. This is the kind of growth journey that Titan has seen. So since the company is making good profits, and also there is a large amount of opportunity of shifting from unorganized to organized, the company could make use of this opportunity because they kept adding stores in every new region that they can do without diluting the per store economics. So even today, when we look at it, every store in Titan makes almost 80 to 90 crore sales on an average basis, and they make almost at the store level closer to 15-16% margin, which is a very high margin given that they almost have an inventory turn of around 3 times. So this kind of a profitability helps them to reinvest this money back into the business by adding new stores. They have also made some very interesting investments into Carrot Lane, as well as they are getting now into international businesses. So Titan keeps on identifying new opportunities for them to keep growing in the jewelry business. This is what made this journey of Titan. Titan has already delivered us 10 bagger sort of from the point that we invested into this stock. We see similar opportunities in other retail companies also in India. We have some 2-3 other stocks also to speak about. But just for an example, we wanted to discuss on Titan. Here we are playing both the service companies which are into exports, both in service as well as in manufacturing. But the services oriented export is predominantly into IT sector. Right now we are not fully invested into it. We will wait for the right opportunity, because right now, given the slowdown in US and Europe, IT sector is going to go through a lean patch in terms of earnings growth. Let's shift to the other segment, manufacturing exports. Here we see a lot of opportunity coming through. India has not been doing really great from an export opportunity point of view for a long period, because we have been losing our market share to Asian nations or even to some of our neighbors in sectors like textiles and even auto sector also to say. But if you look at specialty chemicals, India has been consistently growing and gaining market share. Because here we don't compete with our Asian countries or even with our neighbors. Here we compete with Europeans or Japanese or Korean companies, or to some extent some of the Chinese companies. When it comes to purely playing the labor cost advantage, India probably has not been very successful from a long-term perspective. There are patches in which we have done really well from a short-term perspective. Whenever the raw material prices have been conducive, or whenever there has been a supply chain constraint in other countries, we have done well. But when it comes to sectors like specialty chemicals, we have offered not just only labor cost advantage, but also low cost R&D, which is very important. See, every molecule that an agrochemical company sitting in Europe is identifying, they spend a lot of money and they also want a company to participate in the process of identifying these molecules also. So each of these molecules go through multiple level of synthesis. So if you have an Indian company who can participate in some part of this custom synthesis, and then when these products go commercial, also participate in manufacturing these products in a bulk quantity, the Europeans are really looking for such opportunities or such companies in India to outsource a lot. And given that China has been continuously creating supply chain bottlenecks in chemical space, and particularly chemicals which are facing pharma sector or agrochemical sector, which are very, very important from a global perspective, there I think Europeans have started moving more towards India, which is what China Plus One story is all about, which looks like a very long-term trend, and it is just getting expanded. So let me take an example of Navin Fluorine here. The company started as a fluorine chemistry company, but of late in the last 5 years have started becoming a meaningful player across agrochemical, pharma, as well as new age application for fluorination chemistry. So you have a company which is good in fluorination chemistry, but now finding opportunity under various end user sectors. And the company which used to just do around 500 crore of capex in the last 5 years on an aggregate basis, today we are seeing that he is getting large projects by which he is spending 500 crore capex every year. And this is primarily because the European companies are finding it comfortable, or US companies are finding it comfortable to work with a player like Navin, and also given that the capability that Navin brings on the table and capability to execute these projects and deliver these molecules at the lowest cost possible, in addition to participating in also reducing the cost of manufacturing these molecules for these European and US manufacturers. So these kind of companies we like, and there are many such opportunities that we see coming through. In addition to it, as Europe is going through this energy crisis, their cost of manufacturing is increasing. So we are trying to identify certain specific companies who have a good presence in Europe. We are already researching into some of these companies, but we are waiting for the right entry point in these companies. These companies are typically companies who are having a presence already in Europe, and they are competing with European companies, and they can offer a low cost advantage because the European competitor is going to see at least 5 to 10% increase in cost of manufacturing due to the high inflation driven by the energy crisis that is happening in Europe. So we are looking at further opportunities like that in the manufacturing space as well, which can be in auto sector, or which can be in capital goods sector, or it can be in any sector. But the key is that the company's balance sheet should be good enough that they can make use of this opportunity, invest into it, and they already have presence in Europe so that they can just go and capture the market there. So that is what the opportunity is, and we are looking for such opportunities, and there are quite a few companies here, but we are looking for the right entry point into some of these businesses.